Assalamualaikum students, Assalamualaikum teachers. This today's video is about those topics which I think are important for the upcoming AS Economics exams paper 2, paper double 2, that's a variant we do in Pakistan for forthcoming May-June 2025 examination. I've carefully gone through the past examination papers and I've tried to predict the trend or determine the trend in which the examiners have been asking exam papers in the past papers. So I prepared a list on the basis of those observations. But let me tell you that this list is in no way a substitute to the study or the coverage of the entire syllabus. You know that there is a data response question and it's a compulsory one. It could be from any component of the exam syllabus, syllabus of the subject. So you have to prepare the entire syllabus, no doubt about that. However, the topics I'm going to talk about today briefly should be those topics which you give extra attention to. You should give more focus and more attention to the topics I'm mentioning because I think that they are very important and it's very likely that some of the topics may be covered in the coming exam. The first topic, as you all know, production possibility curve. So we will be preparing individual videos for these topics and we'll talk about these topics in a little more detail. But today we'll be talking or just touching about all these topics. So production possibility curve. You should be aware the difference between what causes a shift in a PPC, what causes a movement along PPC, what is a movement along PPC, what is a movement from inside a point to PPC of PPC towards PPC. I'll show you all these shifts in my next video. What causes these movements? What are the effects of these changes? What is the definition of production possibility curve? What are the impacts in the short run, in the long run? All these needs to be prepared. There is a very famous topic that is rising opportunity cost shown through a concave looking PPC. That topic has been asked in a previous exam paper. So the question which I've chosen for this particular exam paper, and that is from paper 2023 May-June, variant 2.1, question 2A. With the help of a diagram, explain the difference between causes of a movement and a shift in the supply curve, shift in production possibility curve, and consider which is likely to be more effective or most immediate, which is likely to have a more immediate impact on the economy. So this question I've recommended is part of my list of important questions which we'll be sharing today with you. This question should be prepared. Another angle which you need to prepare for production possibility curve is the impact of rising unemployment. A question from that topic is also given. The next topic I like you to pay attention to is the price elastic demand, income elastic demand, and cross elasticity demand. You need to be aware what is the difference, what is the meaning of different signs. What does the positive sign of cross elasticity demand mean? What does the negative sign mean? What does zero mean? If cross elastic demand is zero, what does it mean? Similarly, positive sign of income elasticity demand, negative sign of income elasticity demand, zero income elasticity demand. What do they mean? Let me tell you, it's not enough to only write income elastic demand is positive for normal goods. Of course, it's correct, technically correct. But why it is positive? Because income and demand of a normal good, for example, a five-star hotel, staying in a five-star hotel, a business class travel of Emirates Airline, that is an example of a normal good. Income goes up and demand will also go up. And because there is a direct relationship between changes in income and changes in demand, that is why income elastic demand for a normal good is positive. So you need to give the explanation why it is positive for normal goods, why cross elastic demand is positive for substitutes. You need to be aware of the meaning of the sign. That's what I've told you now. You also need to be aware of the meaning of more than one and less than one elasticity. If income elastic demand is more than one, if cross elastic demand is more than one, if price elastic demand is more than one, what does it mean? More than one means elastic demand. A change in price causes a more than proportionate change. A change in price or change in income or change in price of a product causes a more than proportional change in quantity demanded of the other product if it is cross elasticity of demand. So you need to be aware that you need to use the word proportionate to explain the difference between elastic and inelastic demand. We'll inshallah prepare a video, a detailed one for this topic as well. So the question I've chosen, because I think there's a topic that is important, is cross-elastic demand. There have been questions about income elastic demand in past papers. There have been questions about price elastic demand. Cross-elastic demand is less covered. So I will like you to pay more emphasis to cross-elastic demand, whereas, as I already told you, that you need to cover the entire syllabus. So cross-elastic demand, the question I've chosen is from May-June 2023, variant 2.1, question 3, part A. With the help of formula, explain the meaning of cross-elastic demand and consider which determinants are most important in establishing the size and sign of its coefficient. So size of coefficient more than 1 or less than 1, coefficient positive or negative, determinants. We'll talk about this question in detail in an upcoming video. Another question that I've chosen is from income elastic demand, and that is from 9708 syllabus code 2-3 variant, May-June 2023 exam paper, question 2, part A. Explain with the help of examples the significance of the size and sign of the coefficient. Again, size is more than 1 or less than 1. Coefficient or sign is plus or minus of income elasticity demand for the classification of a good, and consider how confident are you of this classification. Consider how confident are you is evaluation. We'll talk about that. So sign and size, again, this question is being asked again and again. So short run and long run, the difference between short run PED and long run PED is another important topic. And again, the difference between short run and long run PES is also an important question. So the list of important questions which will be giving to you. So what determines PES, price elasticity of supply, and how can we change it, and to what extent we can be successful in changing PES. So these are the questions which I think are important. Moving on, so we move to the next question, and that is indirect and direct taxes. Now, why did I include indirect taxes? There are 4 ways a government can intervene in a market. Maximum prices, a question has been asked in a past examination paper. Minimum price, questions has been asked in a previous exam paper. Subsidies, a question has been asked in a previous exam paper. And the 4th is indirect taxes. No question has been asked. So for me, it's a favorite topic. I feel that there will be a micro question. You need to have, you need to do 1 micro question out of the choice of 2, and there will be 1 question from indirect taxes. And the 2 topics are 2 areas I would like you to prepare. 1, if indirect tax is introduced, what happens to the market equilibrium? Indirect tax raises cost of production, shifts supply curve upward, raises the price for consumers, but reduces it for the producers. Consumers lose because they have to pay high prices. Producers lose because they receive less revenue, and government gets tax revenue. So that's one thing. Quantity traded goes down. That's the impact you'll be showing graphically. And then you may be expected, or you may be asked to compare the tax incidence on consumers or producers. Will consumers bear more burden, or producer bear more burden of the tax? Of course, it depends on PED and PES. Lower the PED, greater would be consumer burden. Lower the PES, greater would be the producer burden. We'll talk about this in detail in an upcoming video, particularly for this question. So you need to know what are indirect taxes, how do they affect the market equilibrium, and how is their burden distributed between consumers and producers. The second area of indirect taxes you need to prepare is the comparison between indirect and direct taxes. Which are more fair? Which taxes are more effective in raising revenues? Which are more fair? What are the benefits of indirect taxes? What are the benefits of direct taxes? For example, direct taxes help reduce inflation. Indirect taxes help reduce import bill because you can have a more specific target. Direct taxes have a more general effect. If you impose direct taxes, demand for all goods falls. But if you want the demand for a particular product, like a demerit good, you want it to go down, then indirect tax may be more effective. But indirect taxes are regressive in their impact. So that's the sort of analysis you need to be aware. So indirect taxes, my favorite topic for micro for this coming exam. The next topic I like you to prepare is the types of goods and how can government intervene in that. So direct provision, we have seen questions about maximum price, minimum price, subsidies, but we haven't seen questions about direct provision of government. So maybe there could be a question from direct provision, and there was a past paper question from direct provision in another variant, and that is variant 2.1 of October-November 2023, question 3, part A. Explain why a government might decide to increase the direct provision of essential goods and services and consider whether such policy is likely to be successful. Another area, I have seen questions about public goods, private goods, merit goods, demerit goods, but I hardly seen the question about public goods or free goods or private goods and free goods. But now in a recent exam paper, there was a question about the difference between free good and public good or free good and private good. So you need to prepare that as well. What are free goods? You need to be aware. And how are they different from other types of goods? And buffer stock scheme, the impact of buffer stock scheme on PES and on the provision of or on ensuring the uninterrupted provision of essential goods, primary goods. That's an important area. The buffer stock you need to be preparing. I'll try my best to prepare an independent video for buffer stock as well. Another important topic for macro. Now I'm moving to macroeconomics. For micro, I've talked about PPC, I've talked about price elastic demand and other elasticity of demand. I've talked about indirect taxes, and I've also spoken about types of goods. In macro, economic growth. What is economic growth? What causes it? What are the consequences? Prepare this topic and you'll thank me later. This is an important topic and very easy one. Economic growth, increase in real GDP. Causes, maybe increase in AD or increase in AS. Better training of workers, more quality workers, more productive workers, more government spending, fiscal tool. Consequences, good consequences of economic growth, raises employment, raising purchasing power, allows people to buy better quality goods, better quality food, better quality clothing, better quality education, better quality health, living standards improve, employment rises, government tax revenue goes up. What are the negatives? Pollution, income inequality, inflation, high import bill. We saw in Pakistan economic growth, but what happened? Imports bill went out of our control and economy collapsed. So positive consequences, negative. Is economic growth always desirable? Yes, it is desirable. Benefits? No, it is not desirable because of the disadvantages I just mentioned. And then the conclusion. So this is a very important topic for macro. And there are some important questions which you can see in the list of my questions. There have been questions about monetary policy in past papers. There have been questions about supply side policy. And what is the third policy? Three policies you do: supply side, monetary. And what is the third policy you do for which there hasn't been a direct question? There has been an indirect question, but there hasn't been any direct question in past examination paper. And that's why I want you to prepare that for the coming exam. Fiscal policy. There has been a question about balanced budget, because deficit budget is expansionary fiscal policy. Surplus budget is contractionary fiscal policy. They did not use the word expansionary or contractionary fiscal policy, but they asked this question: should a government always have a balanced budget? I think still there is a room for a direct question about fiscal policy. Do prepare that. And which economic problem we should focus on? There have been questions about unemployment. There have been questions about inflation. But the third economic problem, which is part of your course, is current account. So fiscal policy and current account deficit. That's the area I want you to prepare. So there have been some questions in the past in the list I'm providing. Please do read that. For example, there's a question in February, March 2024 exam paper, variant 22. There is only one variant in March, and that is question 4, part B. Assess whether contractionary fiscal policy is likely to be the best way to reduce a current account deficit on the balance of payment. And there is another question in October-November 2024 exam paper, variant 2.1, is question 4 part B, assess whether a government should always aim for expansionary fiscal policy rather than a contractionary fiscal policy. So similar question could be asked, assess whether a government should always aim for a budget deficit, because budget deficit is expansionary fiscal policy rather than a contractionary fiscal policy. That could be a surplus budget. So next topic is inflation. So there have been questions about inflation in the past examination paper, but the question I'm choosing now is causes of inflation and the calculation of inflation, measurement of inflation. In a past exam paper, in the recent one, there was a question about measurement of unemployment. I will now expect a question on measurement of inflation. How is inflation measured? What are the difficulties? So there are some questions from that, and you can have a look at the list of the questions I will provide. And causes and consequences of current account deficit. There have been questions about unemployment, there have been questions about inflation, but there have been fewer questions about current account deficit. What causes the current account deficit? What causes the current account surplus? What are the problems or advantages of current account deficit? What are the problems and advantages of current account surplus? This is the area I would like you to prepare. And last but not the least, so if you ask me for one topic from micro, I'll say indirect taxes. If you ask me for one topic from macro for this coming June examination, I'll say exchange rates. What is appreciation of currency? What does appreciation of currency mean? What does depreciation of currency mean? Appreciation means currency becomes expensive. Depreciation means currency becomes cheaper. What causes appreciation? When demand of a currency goes up, the currency may become stronger. When supply of a currency rises, currency may become weaker. Depreciation. So causes of appreciation, depreciation, you need to be aware. And what will be the impact of that exchange rate? Positive and negative. What are the positive effects of appreciation? Appreciation means exports become cheap. Appreciation means currency becomes expensive. Benefits: imports become cheaper. Living standards improve as consumers can get a variety of imported goods at affordable prices. Investors, businesses can import machinery, raw material at lower prices. Their cost of production goes down. Inflation is controlled. So benefits of appreciation: better standard of living, more variety of imported goods, cheaper machinery, cheaper imported raw material, lower cost of production, lower inflation. Disadvantages: exports become uncompetitive, exports fall, particularly if PED for exports is high. And of course, there could be rising unemployment in the industry which provides exports. Similarly, the benefits of depreciation and the drawbacks of depreciation. Depreciation benefits: exports become competitive, exports rise, current account deficit goes down. Drawback: it could lead to both demand pull and cost push inflation. So this is the topic: exchange rate, causes, impacts. Please do prepare that. Thank you very much for watching this video. Please do subscribe our channel, because we'll be uploading videos related to individual questions in coming days and weeks. Thank you very much.